Ladies and gentlemen, thank you for joining us at the historic Brisbane City Hall. I'm Andrea Peters, and I'm the Chief Growth Officer at LGIAsuper. It is my pleasure to welcome you to our fund's first ever annual member meeting. Before I begin, I'd like to acknowledge the traditional owners of the land on which we meet today and pay my respects to their elders past, present, and emerging. As a members first fund, we continually strive to get closer to our members. Teams across LGIAsuper are introducing new programs that are enhancing our member focus, and holding an annual member meeting was the logical next step for us. Some of you may be aware, but from 2020, all superannuation funds are mandated by law to hold AMMs. This is covered under new legislation that followed the Royal Commission. I also need to give you a disclaimer that this meeting provides general information only. It has been prepared without taking into account your individual objectives or financial situation or needs. You must not rely on this information alone as a sole or primary source of advice or guidance for the purpose of making decisions about your superannuation options. If you are interested in exercising your options in LGIAsuper in relation to a matter referred to in this presentation, you should obtain the relevant product disclosure statement and consider contacting an LGIAsuper representative who can give you appropriate advice, which does take into account your particular objectives, financial situation, and needs. On today's agenda, we have 4 key speakers followed by an open Q&A. Firstly, you will hear a message from our chair, John Smith. Secondly, we will hear an update from the fund's CEO, Kate Farah. We will then run through the fund's 2019 investment performance and market update. This will be presented by our Chief Investment Officer, Troy Rick, followed by a short presentation on the latest innovations to our member services, brought to you by the Head of Growth and Relationships, Ben Moles. We will close the meeting with an open Q&A session, after which our exhibition booths will be reopened, and encourage you to come and speak with our exhibitors and enjoy some light refreshments. A lot of information covered in today's meeting stems from our 2018-19 annual report. The annual report is available to you on our website if you would like it digitally, or you can also grab a printed copy, which is available to you at many of the booths. Without further ado, I'd like to hand you over to the first speaker for today's annual member meeting, Chair of the LGIAsuper Board, Mr. John Smith.
Thanks, Andrea, and good afternoon, everyone. Thank you for joining us at LGIAsuper's first annual members meeting. It's been an exciting year for LGIAsuper as we strengthen our commitment to serve our members in the most competitive way possible. We've sharpened our focus on being a boutique fund. This term boutique fund we use throughout the presentation today. And so what does it mean? It means that LGIAsuper is a boutique fund of medium size. We're exploiting the advantages of our size and agility to access niche investment markets and generate those solid long-term returns for members. We've been the superannuation fund for Queensland local government employees since 1965. And we're now open to the wider community and welcoming new members from many different sectors and industries. But local government remains at the heart of our fund. It has shaped our member-first philosophy over the years and helped us retain strong member focus as we serve the wider community. We're a profit-to-members fund, so our members always come first, unlike some other funds that seem to get distracted by their obligation to shareholders. We're proud to be a boutique fund. We're the ideal size for investing in niche markets that generate solid returns. As a medium fund, we can pursue those mid-market opportunities and still make a substantial difference in investments. Some larger funds struggle to match our ability, our responsiveness, and that focus on you, the member. Looking back over the past year, I've worked in superannuation for 40 years, and guaranteed there's been a change to super every single one of those years, and in some years many. But this year has been, the sector has experienced the most significant change ever. Many reviews have come to a head during the year. We've had APRA, the Prudential Authority, focusing on sharpening member outcomes. That's us, that's what we do. The Productivity Commission doing a shake-up of default, so if you don't make a decision as a member of a super fund, this decides where your superannuation contributions will go. And the Royal Commission, which has put a whole industry on notice that we must do better, and we will. This year, the Federal Government Protecting Your Super Protection Act came into effect from the 1st July. The idea of this is designed to protect super balance from unnecessary erosion of insurance costs. More recently, we saw reforms in the Treasury Laws Amendment Act, putting members' interests first. These reforms are designed to protect low balances and the superannuation savings of members under 25 from balance erosion due to insurance they may not need. At LGIAsuper, continuous improvement is built into the fund, which is why we've embraced new projects and innovations, and I'm confident that will improve our service and strengthen all returns to all members. Prior to Christmas, there was a lot of activity in investment markets and certainly some uncertainty, while the second half of the year was characterised by very strong returns. Troy Rick, our Chief Investment Officer, will talk to these. But LGIAsuper's long-term, highly diversified approach is designed to help protect you, your superannuation balance, subject to adverse volatility. Our default MySuper life cycle option for accumulation members has achieved 7.05% for the financial year, while the diversified growth option, which is the default option for many of our pension members, returned 7.68% for the financial year. And we believe this reflects the success of our investment philosophy. Now, as I said, I could spend all day talking about investments and returns, but we'll leave that to Troy later in the presentation. So in the meantime, I've got a message from the board. As a profit to members fund, everything we do is designed to help our members on their journey to a comfortable retirement. Central to this is providing our services in the most efficient way possible. This year, we committed to cost savings with a range of operational and administration efficiencies, which are already enabling us to deliver improved services. These are the best decisions for you, our members, which are aligned with the post-Royal Commission environment, and reinforce our philosophy of putting member interests at the forefront of everything we do. Growth and innovation have been a key priority this year, and continuous improvement is being built into our fund, as I said. We're embracing new projects, which Kate Farrow, our CEO, will talk to you about next. We can't achieve solid returns and solid outcomes for our members without solid leadership. The 1st July 2018, this year, I was delighted to welcome 5 new directors to our board. Mayor Mark Jamieson, Jennifer Sanders, who I know is in the audience today, Ron Dewhurst, Councillor Ros Height, and Ray Burton, who is also in the audience today. We also welcomed an additional special advisor to our investment committee in John Wilson. Our board structure aligns with the best practice in the industry. A third of our directors come from the membership, elected from the membership. A third of our members come from employer representatives, and a third come from independent directors such as myself. You can find more about our board members, their skills and experience from the website, or I think Andrea mentioned there's a copy of the annual report which you can pick up at the end of the session today. We can't achieve solid outcomes without solid leadership and commitment of staff. To all LGIAsuper's employees, not just those in the room today, not just those back in the office, but also those that are probably on the road right now going to the next member seminar or the next workplace to help our members out. I'd like to extend my sincere gratitude to the energy, effort and commitment that those employees have made this financial year. Thank you. And to our members, thank you for taking the time. And I know John talked about a busy retirement, and sometimes it is busier in retirement. You wondered how you had time to work. So thank you very much for making the time to come to see us today. Please take advantage of our staff and the booths around the room. We love to talk to our members. We'd love to answer any questions you have, and particularly, as Andrea said, private personal questions, please talk to us about those. We'd love to help you with that. I have one final announcement which is hot off the press. Following a rigorous review of funds across the country, we're pleased to announce the finalisation of Super Ratings 2020 ratings for the year. Super Ratings is an independent proprietary-based research house which helps super funds monitor and improve their performance and benchmark their services and products against others. This year, Super Ratings have reviewed and assessed over 600 of Australia's major super products against their value for money for members objective. I'm pleased to share with you today that LGIAsuper has again received Platinum. Platinum is the highest rating these providers give, rating for the following products: LGIAsuper MySuper, LGIAsuper Accumulation Account, and LGIAsuper Pension Account. That's a great result. Thank you. Back to Andrea.
Thank you very much, Andrea, and good afternoon, members and guests. It's lovely to have you here. Well, what a year it's been. So I've been with the fund for a little bit over 18 months now, and I must say I'm excited and really pleased with the progress that we're making in our transformation of the fund during 2018-2019. Last year, LGIAsuper worked hard to harness global knowledge and innovation to improve the efficiency and the effectiveness of our operations, and John spoke a little bit to this earlier. With more than 78,500 members in the fund at the end of last financial year, our member education and employer teams travelled widely, helping people get the most out of their superannuation and improving their retirement outcomes. So I just want to take you through some of the metrics, which I am really very happy and impressed with. So this year, we helped members consolidate over 240 million in super, reducing excess fees. As a whole, the fund reached $12.7 billion in funds under management, so genuinely a mid-sized fund. Our teams visited 241 workplaces, reaching over 5,000 members in those workplaces. And all of those metrics were considerably up on last financial year. Our education team ran 39 seminars, which reached over 1,700 members. Our financial advice team held over 1,800 appointments. Our contact centre received over 54,000 calls, and we had over 593,000 visits to our member online portal. And we provided almost 2,800 super health checks, which is a service, as you've heard from Andrea, that we have available over here at the booth after the discussion today. So these are just some of the highlights from the 2018-19 financial year that I wanted to share with you. And to me, those figures really do demonstrate how hard the team are working to deliver more for you, our members. During the year, we entered into significant new partnerships that will help improve our services, grow our returns, and deliver access to global knowledge and innovation. We implemented, first, a long-term strategy which aims to halve the annual costs of providing administration service to you, our members, from 2021. As part of that strategy, we have partnered with international business process expert Tech Mahindra to help us run our back office administration and support our technology. In July 2019, we awarded our life insurance contract to TAL, one of Australia's leading life insurers. All of our members will continue to benefit from competitive insurance premia, as well as better coverage and more convenient services. So I'm really excited that TAL are here today. TAL, as you heard, are offering free health checks and the opportunity to discuss your insurance options, so please do have a talk with them, stop by their stand afterwards. So in what was a landmark shift to drive better results for our members, in July 2019 we selected investment advice firm Jana as our new asset consultant. Jana advises half of the top performing superannuation funds in Australia, so we find ourselves in really excellent company. If you'd like to know more about Jana or the fund's investments, please visit the Investments Showcase and talk to the team, our investments team here. Get to know the people who are looking after your money. I'm also really pleased with our great new partnership with Link Advice, who came on board this financial year to support our in-house telephone advice service. Through Link Advice, you now have access to advice at more convenient times and on a wider range of topics. Our advice team, as you've heard also, are here today, so please, again, take the time to go and visit them at their booth. LGIAsuper invests our members' assets to optimise returns whilst prudently managing all aspects of risk. That's our brief. One of the keys to our success has been our steady investment performance through good times and through bad. We aim to ensure that our members' assets do everything that you need them to, that they are adequately diversified, that there's enough in there to meet payments to you when you need them, and that they have an appropriate level of liquidity. We choose the right investment managers for our strategy, and then we keep monitoring them to ensure that they deliver integrity, prudence, and professional skill. So up on the screen, you can see just a handful of LGIAsuper's expert investment managers. Our investment portfolio also includes a diverse range of really interesting assets within Australia and around the world. And in fact, I think you heard, if you were here for the previous session, you heard from our Chief Investment Officer about some of those. All of those assets help provide diversification and a hedge against movements in local and global economic markets. Both infrastructure and property remained good long-term investments this year, and in fact, infrastructure was our best performing asset class, delivering more than 12% growth. Additionally, our international equities portfolio outperformed the industry benchmark, delivering 10% growth. We put this down to our excellent program of selecting international fund managers. Some examples of our successful partnerships over the past year include Morgan Stanley, who are helping us to tap into emerging markets in countries like China, India, and Korea. Morgan Stanley delivered 14% growth for our members across the past financial year. Another fantastic partnership is with a boutique stock-picking company, Sustainable Growth Advisors. Its strong stock selection across most sectors last year generated annual growth of more than 20%, which is absolutely incredible. In May of 2019, I and the chair of our investment committee and CIO at the time travelled to the United Kingdom to assess the performance of our international fund managers there and also our new asset consultant, and to gain a deeper understanding of the international investment landscape. That trip was scheduled as part of our regular oversight arrangements as responsible trustees of significant assets that are placed with international fund managers. During that trip, we met with our UK property partner, Clearbell Capital, through which we have part ownership of the Sloane Club, which is one of London's most prestigious private members' clubs. In that investment, we're seeking to create value by embarking on an $18 million refurbishment program that will respect the history and heritage of the property, whilst most importantly, generating really strong returns. Overall, we delivered solid returns for our members in the 2018-19 financial year across both diversified and single asset classes. It was a year of uncertainty at home and abroad, and to use the old sporting phrase, it was a game of two halves. As John mentioned earlier, equities worldwide returned negative returns for the first 6 months to December 2018. This was driven by fears of trade wars slowing global growth rates, a slowdown in China, and rate hikes from the US Federal Reserve. Those same markets then experienced strong rebounds in the second half of the financial year. So importantly, strong diversification continues to be a key factor behind LGIAsuper's success and steady performance. Our MySuper under 75 investment option, which is the default option for many of our accumulation members, returned 7.05%. Our diversified growth option, which is the default investment option for many of our members with an LGIAsuper pension account, many of you in the room, returned 7.68%. In an uncertain and fluctuating environment, markets are expected to generate lower investment returns going forward. To counter this, we believe it is incredibly important to continue to diversify investments across different markets and sectors. So if you'd like to learn more about the fund's performance or about your investment options and what's in them, please, as I said, talk to our investment team who are over here after our presentation. Before I wrap up, I'd like to introduce you to our new executive leadership team. Our executive team is responsible for leading the day-to-day operations and performance of the fund, and this year we saw a genuine renewal in our leadership team. Many of the faces that you see on the screen here are in the room today, so please feel free to talk to them. I'm very proud to be part of this group. They're a highly experienced and member-focused team, getting the best out of our partnerships and delivering cost savings for the fund, which ultimately will provide you with better outcomes and better retirement options. With this change, though, I do want to pay homage to the past. I'd like also to thank Peter Gammon, who was our departing Chief Financial Officer, and also our former Chief Investment Officer, David Todd, who ran LGIAsuper for almost 15 years. I'd like to thank Ian Harkler, who's in the room today, our former Chief Risk Officer, who also retired earlier this year. All of those key individuals demonstrated the same care for you, our members, and the dedicated service that I see continuing across the fund, and I wish them well in their future endeavours. So I'd like to close on this note. I'm encouraged by the progress that LGIAsuper has already made in our transformation, and I'm absolutely certain that we'll continue to grow in 2020 towards delivering more for members and your best possible retirement outcomes. Thank you very much.
Good afternoon, everybody. Thanks for your time this afternoon. I've got about 15 minutes worth of material here. We're going to save questions until the end. I'm sure there are some questions. I look forward to answering those questions. I'll spend as much time as we need afterwards talking to every person who wants to ask. So we've spoken about the tale of two halves. Just a refresher on where we were last year. Heading in towards that September-October time period, there are increasing concerns about global growth. We've entered into a slowdown. President Trump and President Xi Jinping were ramping up the trade tensions, and we've got this ongoing saga in Brexit. It was a concerning time for markets. Share markets reacted by selling down. So during that first 6 months of the financial year, you can see the domestic share market down about 7%, the international share market, and we're just picturing the S&P 500 here, also down about 7%. From peak to trough, it was about 20% at one point. And that was a pretty scary time for folks. But the thing that we always talk to members about is the importance of taking a long-term perspective. It's easy to be frightened by those sorts of headlines and short-term outcomes, but maintaining a long-term perspective here is so important. The second half of the financial year, an excellent time to be an investor. 20% bounce back here in share markets, leading to an outcome for the financial year of 11.5% for the domestic share market and about 10.5% for the S&P 500. More in line with historical outcomes, despite the fact that the first half of the year felt very scary. We really do believe that investing for the long term here gives you a much better chance of success. So how did the diversified options perform last year? We've got a full suite here of the accumulation options. We've just had our pension seminar, so we've always included the pension diversified growth. Just a reminder for folks that in the pension phase you don't have to pay tax. How good's pension? 7.7% there for the pensioners last year in diversified growth, 7% for our MySuper strategy. That's a pretty good outcome. It may not have felt like it at the time, but that's a pretty good outcome. We're big believers here in offering choice, so we do have a range of diversified options for those who wish to take a more aggressive approach, all the way through to those who take quite a defensive approach. Given how share markets behaved last year, risk was rewarded. We tended to find that the more aggressive options had higher returns. But even our defensive option returned 4.7% for last financial year. And I'll just remind folks that's after investment fees and taxes. So that's a pretty good outcome. That's a pretty good outcome. That long-term perspective. If we think about that MySuper strategy, over the 34 years to 30 June, we've delivered more than 9% per annum. Right? That's a really pleasant outcome. Significantly returns above inflation, that thing that eats into the purchasing power of your money. That's what we're really trying to do here, is deliver you increased purchasing power over time. For those in the pension phase, these returns only go back 16 and a half years, 8% per annum. Again, well ahead of the rate of inflation. So for folks who are in the pension phase and drawing down 4 to 5% per annum, it is quite likely that your account balance has been going up over time. Right? That's a really pleasant outcome. Let's drill down to the single asset class options here. So we have this pool of diversified options. We also offer people the choice of some single sector options if they wish to build their own portfolio or have an advisor do it for them. And the range we have here is our domestic share portfolio, our international portfolio, property, bonds, cash, and of course our socially responsible Australian shares option. So again, it was a risk on market. Risk was rewarded last year. Very pleasant returns there for share market investors, but also for those in the property portfolio. Our diversified fixed interest option returned 5.8%. Now, given the expected returns on bonds is now very low, that's a really pleasing outcome. We also have our cash option. That returned a low 1.7% per annum last year. That is after investment fees and taxes. I don't have to tell you how low cash rates are. I remember making my first term deposit as a much younger and thinner man at 18%. This investment game's easy. Put money in the bank, go away for a year. Now you're struggling to get 1.5% for a term deposit. It's a very different environment. Cash is there for those folks who need immediate liquidity, who are very scared about market returns. It feels very safe. Cash is very safe in the short term, but I would simply offer you a cautionary tale. Cash is safe in the short term, but can be very risky in the long term because it's not going to generate you a sufficient return to live the lifestyle you deserve in retirement. So an increasing topic of discussion in our society and within the investment sphere is a so-called environmental, societal and governance approach. Right? And so I wanted to take a couple of moments here to outline what the fund does with respect to so-called ESG or SRI approaches in investments. Now, it is a topic, I'm sure you're aware, where there are strongly held opinions in the community, but there are also very diverse opinions. The approach that we've taken here at Local Government Investment Authority is not to negatively screen for the broad portfolio. So what does that mean? It means we think that ESG topics are important. We think that our investment managers should take environmental, societal and governance considerations into account when they make investment decisions on your behalf. But we don't think it's the only thing that they should think about. We don't think they should think about it in isolation, and we don't think it's more important than the other considerations that they have to make. On balance, a holistic assessment of the risk and return opportunities. A couple of examples that we see out there in the community. Some of the large power companies like AGL and Origin Energy, they do have a very large carbon footprint, but they're also extremely large generators of renewable energy. I think about a company like Tesla. Love Tesla, think it's an amazing opportunity. Is it a wonderful ESG company because electronic vehicles help reduce carbon footprints? Or is it a challenging company from an ESG perspective because the governance arrangements there are not best practice? Well, it can be both. And so this is why we urge people to take an on-balance and holistic approach when thinking about these ESG investments. But we do believe in choice. So for those members who wish to express a values-based approach to their investment strategy, we do have 2 standalone SRI options. One here for Australian shares, and then a more diversified, balanced approach for SRI. So how are these options different to the broader investment strategy that we undertake? So the first thing we do is we select investment managers who are specialists in this ESG approach. In the Australian equities portfolio, we use AMP Capital Investors and Pendle, the former BT Investment Management Group. And for the balanced option, we use AMP Responsible Investors. Right, so specifically in respect to the SRI portfolios, we do undertake some negative screening in there. And I'll make sure that I read this one correctly. We very much ask managers to avoid investments in companies with significant revenues from high negative societal impact, including those in the production of alcohol, armaments, gambling, pornography, tobacco, and uranium. right? It is a very specific list. There are a very broad range, it's a very broad church of opinions about SRI and ESG investing out there. We do offer choice for folks. Right? Our basic belief here with ESG, though, is that it's an important risk. It's somewhat priced into markets, but it's not the only thing that's priced into markets. So we can't do this job all by ourselves as much as we would like to. We need to find trusted investment partners to invest your money. Who are some of these folks that go out there and do the hard work of investing your dollars? We've listed a few of them here on the screen. Kate's already spoken about a few others. There are some names here I'm sure you'll find very familiar. The folks at QIC down the road, they're very big investors. AMP, I'm sure everyone's heard of that. Goldman Sachs, great big investment firm in the US. There are some other names on here that you may not be familiar with, and it's simply a demonstration of what Local Government Investment Authority does in terms of scouring the world, looking for the best managers to put your money to work. Right? So folks like Black Creek, based in Toronto in Canada, Columbus Circle, Artemis, Equus, River and Mercantile. These are names that are unlikely to be familiar to you. Right? So all I want people to take away from this slide here is that we do have a wide range of managers working on your behalf. Most of these are domestic, but a lot of them are also international. We are big believers in diversification. Nice picture here of how we spread your money around. The sorts of qualities we look for in those managers. First of all, it's integrity. Without integrity, we've got nothing else. They need expertise that's suitable for the mandate, but also experience, right? The so-called grey hair factor. And the older I get, I must confess, the more important I think grey hair is. But it's also alignment, right? These folks don't work for free. They want to be paid. I'm happy to pay them, but I don't want to pay them over the money, and I want them to work hard for every dollar that they earn. So these folks that we spread the money around the world to invest in, right? The US has been a fantastic place to invest. I've just come back from a 2-week trip. I actually feel more positive about the world having been around the US for the last 2 weeks. There are some really interesting opportunities out there for us to put money to work. Increasing focus for the fund, though, will be finding further investment opportunities away from the well-known, right, in emerging markets in particular. So we have a manager called I Squared, who's an infrastructure manager, invests quite a lot of money into emerging markets. So we've done solar power in Japan. We own Indian toll roads. We've done hydropower in South America. Emerging markets are attractive for 2 reasons. They tend to be less well-researched and therefore offer the chance to find underpriced opportunities. We also find that economic growth tends to be stronger in emerging markets, and economic growth is one of the foundational parts of a growing investment portfolio. Right? So we will continue to search for these new opportunities over time as a broad part of this diversification theme. So we diversify internationally, we also diversify domestically. As much as I love Queensland, I can't invest all of our money here in Queensland. We do find other interesting investment opportunities around the country, from gas pipelines in Tasmania to regional livestock exchanges to wind farms. Right? We will spread the money around when we see the opportunities to do so. Even for the money we invest here in Queensland, diversification. You're going to get bored with us talking about it, but diversification really is our most effective form of risk management. So whether it's commercial office blocks down here on Eagle Street, it's shopping centres in Toowoomba, it's the regional livestock exchange, it's the light rail on the Gold Coast, it's the land deal that we've done with Village Roadshow on the Gold Coast. Right? We do want to spread that money around. We're looking for opportunities for a fund of our size to put checks to work that a mega fund couldn't use. 20, 30, 50, $100 million checks. Right? We can generate the sort of returns that you folks are going to need to live the lifestyle you deserve. For the mega funds, I totally respect what they're doing, but they can't get out of bed for less than a $1 billion opportunity. That leaves crumbs on the table for us, and we're very happy to take all of those opportunities. So what's going on in the world right now? It's been a really good time to invest. We're coming into a very difficult time. Presidential election cycle. One man in particular, believe me, he occupies a lot of thought space in the US. There is wall-to-wall coverage on the television networks about the impeachment hearings. And so there's a natural concern that this might lead to further uncertainty and volatility in financial markets. When you go back and look at history, as distracting as the impeachment hearings are going to be, you get a very different picture. Right? So lots of numbers on this page here. You don't need to know the numbers, just look at the colours. If I focus on the third column, right, this is the year we're currently in, the 3rd year of the presidential election cycle. This is actually the best year for the S&P 500. Right? The 3rd year of the presidential election cycle tends to be very positive for markets. So the sorts of returns that we've seen this calendar year are nothing unusual at all. Presidents like to get re-elected. They're politicians after all. So they tend to stimulate the economy. They want to spend more money. They prefer lower interest rates rather than higher interest rates. So my great hope and expectation is that President Trump and Xi Jinping reach some sort of an agreement on the trade tensions that we're currently seeing. I hope there's further spending on infrastructure. The US could certainly do with it, in which case the sorts of returns we've seen this year may actually be repeated coming into the first half of next year. If I move across to the fourth column, the third and the fourth years of a presidential election cycle in the US tend to be very positive. Right? So my hope after being in the US for a couple of weeks is the next 3 to 6 months turns out to be quite a good time to invest. If I cast my mind further forward than that, 2 to 3 years out, it's the post-election period that does give me some concern. If you look at those first two columns, there's a lot more red in there, a lot more red, and that's the payback period. If you're going to be re-elected into Congress, the Senate, or as a president, and you need to do yucky things or nasty things to the populace, you do it after you've just been re-elected, not before. So you do tend to see this pull forward of good news and this pushback of bad news around the election cycle. I'm not telling you anything you don't know. We've got a couple of good elections coming up here next year as well. But we do think that period beyond the election is going to be a very difficult one. Right. Here's one example. Anyone seen negative interest rates before? Because I've gone back and checked my economic textbooks. Yes, they're a little bit old, but I can't find negative interest rates in the textbooks. Yet we've got negative interest rates on government bonds in Japan. We've got negative rates in Europe. We've got negative rates in Switzerland. For high-quality borrowers in Denmark, you can get a mortgage on your home and be paid for it. What do you think that does to Danish mortgage prices? You are paid to take out a mortgage. This is a really unusual monetary policy experiment. We haven't seen something like this quite before. That does give us a little bit of caution. I think it is certainly a time to be alert, but not alarmed. And if I was going to be concerned about one thing, it's this. Right? There's a pretty good signal from history about the returns on government bonds compared to the returns on cash. When you see those two lines cross over, that tends to be a reasonably reliable signal about tougher economic times coming down the pipeline. Technically, I should use the R word at this point. I don't like to talk about recessions because people take that word away and they become overly concerned with it. Right? So this is usually a good, reliable indicator in history that we've got tougher economic times ahead, but there's a big message that the chart hides. Right? The first part is, it's not guaranteed. Right? There are no guarantees in life except for death and taxes. So even if we have this crossover signal here, we might get some slowdown in the economy. It's not guaranteed that we have to use the R word. So please, don't walk away from today being deeply concerned about the world. The second thing I would say is, again, when you go back and look at the history of financial markets, the 6 to 12 months leading up to the recession can actually be a really good time period to be an investor, a really good time period to be an investor. So there can be a large opportunity cost to becoming bearish too early, and we won't fall victim to that here. We're certainly cautious about the outlook. We're alert but not alarmed. So what we're going to do instead here of running away and hiding in cash is look for opportunities to further diversify your investment strategy. One of the things that we've recently invested money into here are emerging market debt. So we're lending money here to governments. They're just not governments in Australia, the US and Europe. So we're lending money now to Indonesia and India and Mexico and Russia. I'd like to invest some money in Chinese government bonds. Right? And the gap here between the green line and the black line doesn't look very big, 2 to 3% per annum. But if our bond portfolio is currently generating 1 to 2% per annum, and I can lift that to 3 to 5% per annum, that's a 75 to 100% increase in the income I can generate. So for those members in the lower risk options, cash, defensive and stable, what we're trying to do here is build out a sustainable income stream for you that doesn't rely upon taking lots of extra market risk. Right? So LGIA has always been a fund that's willing to be different, looking for different opportunities, those mid-market opportunities, whether they're here in domestic or overseas, to increase your returns, but we're very cognizant about the risk profile involved. Thank you very much for your time. I look forward to answering your questions.
Thank you, Andrea, and good afternoon, members and guests. It's great to see so many of you here at our first annual member meeting, and it's also great to see a few familiar faces in the room from previous LGIAsuper seminars or events similar to this. It's my role today to talk to you about the different services that we have available to you, our members, and some of the recent news and innovations or changes we've made to those particular services. The first item I'd like to talk to you about today is our annual benefit statements. This year, we transformed our statements, and I'd like to run through you the highlights of this new interactive format. We hope you find this new interactive format more useful and easier to consume, and our new features such as the ability for you to register for Member Online directly from your statement, a button to help you search for your lost or unclaimed superannuation, which we recommend you all take 5 minutes to do, and also the ability to see your account balance and also the information that we hold about your account. There are also some interactive statement features across investments, insurance, your transactions and beneficiaries. So if you have questions about this new interactive statement today, please see one of our team or give us a call in our contact centre. When you get home later this evening, if you haven't already, I strongly encourage you to look at our new Member Online dashboard. Over the last year, we've had more than 32,000 logins to Member Online, and we have over 590,000 people visit our website, which is up 25% on the previous year. And we now have some fantastic updates to Member Online, such as being able to track your superannuation contributions against the contribution caps for each financial year, to check your insurance cover or your voluntary contributions, and it provides a much easier snapshot to your account as soon as you log into Member Online. We will continue to make updates to our Member Online portal as we go forward as a fund. For many of us, our income needs do change throughout the year. That's why LGIAsuper has made it easy for you now to change your pension payment details online. Many of our members with pension accounts have told us they would like to manage their account from wherever they are, and that includes while you're travelling around Australia or around the world enjoying your retirement lifestyle. We've taken that feedback on board and are now very pleased to let you know that you can update how much your pension payment is on a regular basis. You can also change the frequency of which you receive that pension payment, whether it be fortnightly, monthly, quarterly, half-yearly or yearly. And you can also update the destination bank account in which your pension payments are made to each time. In the past year, I should say, we've also introduced 2 new insurance calculators, which can help you understand the cover that might be best for you and how much that insurance cover will cost you. You can get a quick estimate or a complete estimate of your overall details by accessing these calculators online. To do so, it's great to have a little bit of information about your income, your expenses, assets and debts ready to get the best use out of these calculators. We have, over the last 12 months and the last financial year, streamlined our financial advice services. We've expanded our Advice Direct service, which we offer to you at no additional cost to your membership, to include both investments and insurance advice. And this has been added to our existing contributions advice. Our comprehensive advice service continues to be offered on a competitive fee-for-service basis and can help you with planning your retirement or making that transition from accumulating your super into drawing down upon it. Our contact centre is proudly based here in Brisbane, Queensland. We have member services specialists available to assist you between 8:30 and 5 p.m, Monday to Friday. Recent initiatives include improving the faster telephone response times, enhancing our skills to resolve more inquiries at the first contact, and also being able to direct you to insurance and financial advice services, should you wish. As Kate mentioned earlier, never have we been more active in the workplace and with seminars. We've had a 14% increase in the people attending a face-to-face session, meaning more than 5,000 people sat down with one of our team throughout the year. We conducted 2,800 super health checks, and we now offer this service both over the phone and through video conferencing facility, should this be of interest to you. So no matter your age, your understanding of your superannuation, a super health check is a fantastic way to check in on your superannuation account and to check that your retirement nest egg is growing adequately. We have staff here today who are welcome to sit down with you and undertake a super health check should that be of interest. We've also continued to run our seminar program over last financial year, and we ran, as we mentioned earlier, 39 seminars with almost 2,000 people attending. These are a great forum for you to learn about your investments, your superannuation, or how to plan for retirement or to enjoy your retirement lifestyle. Please stand by for your inbox and also on our website to receive invitations as we continue that service for you throughout 2020. I'll now pass back to Andrea. Thank you.
Thank you, Ben. Thank you, Ben, for that. I'd now like to welcome to the stage our Chief Financial Officer, Garnet Hollier, and our Chief Operating Officer, Eleanor Noonan, who will be assisting us in the next segment of the session. We now move into question time. We will open up to the floor, and just a reminder that you have John, Kate, Troy, Eleanor, Garnet, and myself available to answer your questions. A reminder that we won't be able to address questions regarding individual accounts, personal financial matters, sensitive matters, or grievances, but if you have a question that's more personal in nature, I encourage you to visit our exhibitors at the end to speak with our team. Time is limited today, and I apologize if we don't cover everyone's questions in the time allowed. We will aim to answer one question per member. However, if we can't respond to your question within approximately 2 to 3 minutes, then we'll follow up with you personally at the end of the meeting. So who would like to ask the first question? Gentleman in the back with the white cap? Oh, sorry, we'll just bring a mic to you. All right.
Good afternoon. Question for Troy. Why do we trust AMP still?
Yeah, it's an interesting question. So I will simply confess this is week 10 for me. I'm relatively new to the organisation. AMP as a brand, as a company, has undertaken a number of activities which no one is proud of. The particular investments that we have with AMP are done through their investment management arm, AMP Capital Investors. So I'm happy to report that the issues that are very public and were aired during the Royal Commission haven't been influencing on your account. Having said that, one of the things that you get the blessing of doing as a new person to the organisation is a top to bottom review of everything that we're doing. So I'm taking the task in the first 3 months to go and see every individual investment manager, and over the first year of my tenure, we'll be reviewing every investment manager and mandate.
Another question? Over here, Yusuf, sorry, to the right.
I think this is probably for Troy. How well prepared is the pension account, which the majority of members invest in, to a likely impeachment of President Trump? I'm glad that you really did touch on that subject. I'm just wondering how well prepared the fund is for an impeachment.
Yeah, that's another great question. I had the privilege while I was in the US of meeting with former Deputy Director of the CIA, and I can't speak about everything that we discussed, but he made 2 very important points. There really are 2 Americas. I know that we get the impression over here that there's a left and a right, there's a red and a blue. It's absolutely the case, and there's almost no one who sits in the middle. He's incredibly bifurcated from a political standpoint. From his point of view, he's now a political consultant. Trump's going to be impeached, but Trump's not going to be removed from office because the Senate's never going to get a 2/3 majority. And again, we go back to look at history here. Remember when Bill Clinton was impeached? Right, neither do I. Actually, 2 great years to invest in the S&P leading through to the end of Bill Clinton's term. So Trump's a politician. He wants to be re-elected. He loves conflict. He loves this idea. And in the meantime, he's going to spend. He'll ramp up the trade tensions with China because his base knows him for immigration. They know him for trade. Coming to the 2020 election, markets are currently pricing that Trump gets re-elected. That's what's currently priced into market. And certainly the former Deputy Director's view of the world is, if you're going to be a betting person, you put money on Trump being re-elected. So for our portfolios here, given our views on diversification, the US is too big for us not to invest money there. But on our understanding of the world, we don't think that situation is going to have a material negative impact.
Another question? Okay, over here.
Thank you. I noticed that the Chief Risk Officer is not at the table, so my question is to the CEO. How is the fund factoring in climate risk into its investments, and what sort of risk strategies and risk plans have you got for the whole range of potential outcomes that we're seeing happen? How are you factoring that into the fund?
Yes, thank you. That's a fantastic question. So we have listened to our members who've told us that the most important thing that we do is to manage our fund with an eye to risk, and particularly downside capital protection. And we extend that philosophy to every risk. So climate risk is absolutely a key, along with the other environmental, social and governance risks that Troy spoke about previously. We don't invest directly in companies. So what we do is that when we are reviewing companies and when we have our asset consultant review the investment managers, when we're reviewing them, we do make sure that environmental, social and governance questions are considered, and the approach of those investment managers is considered as part of the rating system, which will allow us to either enter into a fund manager or continue to be in a fund manager. So it's a formal part of our framework, largely delivered through our asset consultant. But it is something that we think about more broadly, and as Troy said earlier, it is something that I think there's an opportunity for him to bring his own stamp to. Do you want to add some thoughts to what you said earlier?
Absolutely. My personal journey on this one started many years ago at a former employer. When the real estate team came to us and talked about wanting to spend some money, changing the way the doors in the shopping centres operated, insulate the heating pipes for the water system, and operate the air conditioning system in a different way. All right, that sounds like a very tertiary order consideration. And the IRR on that project's 14%. Okay, now you've got my attention. Where I think this consideration of climate change risks is most important is for the very long duration assets that we own. So if I owned a seaport, for example, as I did in a previous role, I'm very interested in what might happen to sea levels over time, and is the physical infrastructure of the port at risk. But not just the physical infrastructure, what about the businesses who actually sit behind that infrastructure asset? That particular asset had a large proportion of grain, very cyclical, very, very dependent upon weather conditions. So thinking about the cash flow at risk, for example, is an important part of that consideration. And I think that the most important part of that is actually the longer duration assets that we own. Look, there is a big conversation happening in the economy around fossil fuels. There are certain substitutes that are out there at the present time, but there are certain parts of the fossil fuel cycle which there are just no commercial alternatives to. And the one that obviously comes to my mind is metallurgical coal. We live in an economy that's incredibly dependent on steel production. Turn those hundreds of millions of tonnes of iron ore into something useful. It comes out of BHP and Rio in Western Australia. We need to use metallurgical coal. So every investment manager that we hire on your behalf has to take ESG risks into account as part of their broader risk and return consideration. But as we said, we don't think it's best done in isolation. It should be a holistic assessment, and it should be an on-balance assessment. We understand that not everyone's going to agree with that approach, but we do want to be very transparent about that, and we're very happy to answer members' questions about it.
Thank you. Gentleman here. Thanks, Shay.
Just on this geopolitical side of things, you've mentioned you diversify looking at a lot of international players. Is China in there?
I'm sorry, could you just repeat that?
Is China part of that equation given its Belt and Road Initiative?
Yeah, so China is obviously one of the big growth drivers here in Australia. We feel we get plenty of exposure through our domestically sourced assets. In thinking about our emerging markets exposure, one that I've always been intrigued about is India, simply because I can find 20 people to talk to me about China and maybe one to talk to me about India. The opportunity set in China is a little bit different to other places, given the nature of the government. We've been thinking carefully here in the last 18 months about the potential infrastructure opportunities, one belt, one road. The advice that we're getting, and I happen to agree with it, is that there's no shortage of capital in China. And state-owned enterprises are a very large part of the economy. So unless you're very cosy with the central government, infrastructure in China is a much tougher investment. So we'd rather do our investing in China through listed shares. I'd like to get some exposure to Chinese bonds and other asset classes out there. But again, I think your question about diversification is really important.
Great, thanks, Troy. Is there another question in the back? I think Beck, you want to, man with the sunglasses on the head?
I actually asked this question and it was partially addressed by Troy. Regarding the socially responsible Australian shares, you said that it excludes certain industries and certain activities, but how much does it, how much would someone like AMP Capital go with this particular organisation, say through what was found in the Banking Royal Commission has been found to be acting unethically, so would that particular organisation be removed from that portfolio?
Yeah, it's another good question. So there is a separation between AMP as the large ex-mutual and AMP Capital investors. It's difficult for me to say about some of the things that we would like to do because I would like to talk to managers before we do it. I haven't actually met AMP Capital investors yet in my current role. It is a difficult thing for us to think about investing in an explicit SRI investment strategy with an organisation whose parent company has such a poor record on these issues. It is something that weighs heavily on our mind. And if you'd like, I'm happy to talk to you about it offline.
That's great, thanks, Troy. Any other questions from the floor?
Hello, this is a question for Troy. We're, I guess, in a very early stage of having the financial industry being disrupted with peer-to-peer transactions, decentralized transactions, blockchain, and all that. Is there any plan to get exposure to cryptocurrencies in the future?
I do like a different sort of a question, so thank you. The short answer is no. For those who aren't familiar with cryptocurrencies, they're an alternative form of money. They come with some particular challenges for an institution. Right? So first of all, there's a scale question. But the one that gives me most concern is the fact that there have been some noticeable fraud instances overseas. And I think about Mt. Gox in particular, where it was a couple $100 million that just disappeared into the ether. Cryptocurrencies don't generate a yield. So as a classically trained finance person, you try and put a value on an investment. I can't put a value on crypto. I know there are people who trade these things on a speculative basis, and I've got no issues with that whatsoever. But as a long-term investment strategy for the fund, I don't think crypto plays a part in our portfolios. Blockchain's an interesting one to talk about, though. You know, you look at what the ASX is trying to do on settlements. That's a different thing.
Thanks, Troy, again. Any more questions? Take one more.
Again, Troy.
I'm feeling very popular here.
Yeah, I think you're the man that probably has the most. If others have the information, please answer as well. You're mentioning metallurgical coal and iron, steel. Understand the relationship. Not quite understanding that nuclear's on the bad boy list, and yet coal isn't.
Yeah.
My question more is about why is nuclear on the bad boy list? They both have poor histories, in a sense.
There are environmental risks and negative connotations with both, right? So again, I'll confess this is week 10 for me. I haven't had a chance to do a top-to-tail review of every single thing that we do. Nuclear power does bring with it some environmental benefits, right? And complete reduction in CO2, apart from construction, is one of those. The challenge we have is waste disposal. Right? The US is really struggling. The Yucca Mountains facility in the US is dramatically underutilised. What do you do with nuclear waste that might be around for 30,000 years? If we can nail that one, and I know the CSIRO is doing some interesting work with vitreous glass, then we can talk. But for the present time, uranium's on, I won't call it the bad boy list, it's on the excluded list for the SRI options. It's a really low part of any investment portfolio because it's hard to get exposure to in the first place.
So just to be clear, it's the socially responsible options where we have the divestment, forced divestment and the exclusions. So that's the socially responsible shares, domestic shares, and socially responsible balanced. In the other portfolios, the ones that, for example, if you were here for the pension seminar earlier, in those other portfolios, we don't exclude, we don't give mandates to our investment managers that say you will not invest in this. However, what we do is we ensure that they have a rigorous process to consider environmental, social and governance factors when they're looking at what they want to invest in.
Thank you. Yep. Oh, yeah, thank you.
Just 2 points, perhaps of a lighter nature. I'm glad to be on the baby boomers age group and into retirement, but being of old school still, I've accused many times of my kids and younger generation, our media is very negative, which leads us to a bit of worry today about we were going to get some worrying news. I don't know how we can counteract that, but maybe it's just a statement I'm making that the media is very negative. And we've got a younger brother who's working in it too. And secondly, LGIA, I saw recently where they sponsor an NRL team, so I might turn some allegiances to that. Who's that? Was it Canberra or?
So we had sponsored the Cowboys previously.
Cowboys,
but,
yeah.
we no longer sponsor them anymore. We've finished with the season, and we do wish them the very best in the next season.
Just in terms of your point about the media being negative, I don't think that it is just the economy or just the superannuation sector that are the subject of that negativity. When I look around, I do think there's an awful lot of negativity on pretty much everything at present. And that does mean that people can get really worried about their longer term investments. So it's been quite interesting to me that there's starting to be a narrative between the negative sort of political stance and actually some quite good economic numbers. So when Troy spoke earlier, he did talk about the fact that he's not talking about the R word. He thinks, in fact, we've got a couple of years of reasonably okay, muddling along, solid performance for the next couple of years coming into the presidential election. I think it's important that we look at the data when we're actually considering what the outlook looks like. And as he said, let's be alert to the future, but not alarmed.
Negativity sells. If
Negativity
I'm running a
sells.
newspaper, if it bleeds, it leads. Let's make fun of old people, let's embarrass them, that'll get headlines. This whole meme around, okay, boomer. Yeah.
We might take a question that was asked during registration. Ben Moles is going to read out one of the questions that was asked when members are registering.
Thanks, Andrea. We had a few questions along this line. Did LGIAsuper need to answer questions relating to the Banking Royal Commission? Or were there any concerns that the Banking Royal Commission raised about LGIAsuper's conduct in any way, shape or form?
Thanks, Ben. I'll take that one. Simple answer is no. We weren't asked to provide any information in relation to the Royal Commission. Just to expand on that a little bit, we were talking to other super funds in the industry during that time, and quite frequently we visited funds who said, have you got your letter yet? Our answer was, no, we haven't received a letter yet. Can we have a copy of yours? Because we wanted to be prepared just in case we got asked the question, but the questions never arose. And I think it's a justification of what we do, the fact that we are completely transparent, and the fact that we've been doing this for a very, very long time. And I think the people that really did get caught up in the Royal Commission were more the retail funds, more the ones for-profit funds, but we all need to make sure that we continue that strong stance going forward. And I think some of the banks, the IWFs and the AMPs of this world, they're going to have a tough time ahead. It's been very difficult for them. They've seen many billions of dollars of outflows, and that's generally gone to funds like ours in the not-for-profit sector, and we think probably those funds are better prepared to provide services to good members like you going forward.
Thank you.
Thanks for the question, Ben.
If there's no further questions from the floor, I'd like to give a special thanks to our partners, LGMA and to TAL, for joining us today. I also want to give a big thanks to Rebecca from our marketing team for creating this first AMM. It was a lot of hard work and collaboration from all the teams to deliver this, so a big thank you to them. And thank you to our members for attending our first annual member meeting. We will have today's video and meeting minutes available to you in the coming weeks. Please don't forget to fill out your the surveys, and we'll collect it from you. It's really important for us to get that feedback to see how we've done today for our first annual member meeting. And now I invite you to please come and join us for some light refreshments and to further have a chat with us. So thank you very much for your time. We really appreciate it. Thank you.
Thanks, everyone.
Thank you.